I don't think people understand how the U.S. Federal Reserve's interest rate decisions impact day trading. The effects ripple through the economy. Interest rate changes have a more rapid effect on markets than on the economy at large, as markets routinely attempt to predict how any changes will affect prices and the economy. Whether one is trading futures, foreign currencies, or stocks, there will always be an impact of interest rates on day trading strategy. Understanding the economic impact of interest rates is a necessary first step to successful day trading. Interest rates are crucial to the economy. The central bank of the United States is the Federal Reserve. The Federal Reserve pays interest on money in reserve for banks, sets a rate for overnight deposits, and sets a discount rate for banks to borrow from the Federal Reserve System. By adjusting these rates, the Fed can drive the rates of interest that banks lend at and pay for deposits higher and lower. When rates go up, that makes it more expensive to borrow money, which acts as a drag on most aspects of the economy. This negatively affects businesses and the housing market, while it drives up the value of the US dollar versus both other world currencies and a whole host of commodities like crude oil, wheat, coffee, and gold that are routinely priced in US dollars. When rates go down, it tends to stimulate the economy and drive down the value of the dollar against world currencies and commodities. The Federal Reserve typically raises rates to drive down inflation and lowers them in order to stimulate employment and the economy. Why are there not more people talking about how interest rates influence market volatility? A recent example of this is when inflation surged in 2022, and markets predicted that the Federal Reserve would step in to raise interest rates. The S&P 500 stood at 4,766 on the last day of 2022 and fell to 3,583 by mid-October of 2023. The ride down was extremely volatile as the Fed increased its funds rate from 0.25% to 3.35% and kept raising it. During the same period, crude oil had already fallen from its previous peak, but had a similarly volatile set of price swings as the market tried to predict where interest rates, the dollar, and crude prices would settle. For a day trader, the task is not to wait for Fed rate announcements so much as to read market sentiment and use discipline in adapting trading strategies to the market one has, and not the market that one would prefer. Am I the only one that didn't know about adjusting day trading strategies during interest rate hikes? Interest rate changes happen when the Federal Reserve Open Market Committee meets. This happens on a scheduled basis, always a Tuesday to Wednesday, with an announcement by the chair of the Federal Reserve Wednesday afternoon. Because the markets know exactly when this will happen, day traders can often use a buy on the rumor and sell on the news approach, as markets commonly get overexcited at the prospect of a rate hike or cut. As we have noted previously, it is commonly wise not to have open trades immediately before, during, and after the Fed chair speaks and announces rate changes, as the volatility at this precise time can be very risky. Because the Fed bases its interest rate decisions on inflation, unemployment numbers, and economic growth or contraction, similar trading opportunities occur when the consumer price index, non-farm payroll, and economic indicators like gross domestic product are announced. Let's talk about how low interest rate environments can create unique trading opportunities. There are times when interest rates do not fluctuate very much. A prime example was during the first years after the world started to recover from the financial crisis, and again after the Fed stepped in to rescue the economy and the markets during the COVID crisis and crash. Both of these times, the Fed funds rate remained unchanged at 0.25% for 6 years, and then for nearly 2 years. During both of these times, the stock market rallied, and commodities like crude oil rallied, but also experienced extreme volatility. During both of these periods, much trading was based on FOMO, or fear of missing out on a continuing rally, interspersed with panic at the thought that one had overstayed their welcome in a market about to crash. The disciplined day trader who keeps one eye on fundamental trends and the other on market sentiment, as expressed by technical indicators, can profitably trade in such environments. I'm sure you've heard the news. When interest rates are changing, or more importantly, when the market is anticipating changes, this environment can provide the disciplined day trader with ample opportunity for profits. However, it can be just as easy for the unprepared and undisciplined day trader to lose money during these times as to profit. When markets are volatile and potentially more profitable, it is exactly the time to remember to always use stop-loss orders, effectively manage leverage, use discipline in following a proven trading strategy, and maintain balance in one's day trading positions. The key to success is to day trade in situations where you can reliably predict profits and stay out of the market when pricing becomes more crazy than rational and thus potentially dangerous, such as the exact moment when the Fed chair announces a rate increase or cut. Thanks for watching. Please subscribe to my channel, and don't forget to download your free training guides.